Hello, my name is Junganeli, and today we are going to be joining a Zoom class. So make sure you subscribe to the channel.
Aeroflot, which is a Russian airline, and leased out planes from people in Bermuda and Luxembourg, in Malta, and these people who gave out their planes for the Russians to be able to use are finding it difficult to collect money because the Russians have to pay them money for using their planes. You lease a plane. It's like you borrow a car and then you have to use it, then you have to pay the owner of the car. Now the owners of the planes can't be paid. Why? Because the payment system has been kicked out of the payment system. There are people who have open mics. Can we be able to have these mics shut down?
It's different from the non-edible ones. They're two different things.
Can we be able to have these people shut down, please?
Edible, like at the bakery, if you want something, if it's not edible, you just go to the photocopier, you photocopy, you put on that cake. But that okay, like the other side.
Can you please,
members, can you mute?
Ferdinand, mute, please.
Members,
Ferdinand, stop disorganizing us.
okay, I think we can proceed. Let's be disciplined and shut down the mics. So payment, you can see that payment is critical. And when you're talking about payment, like I've emphasized, if we go to the slide, payment basically requires that and all the people who are involved basically in trade finance require one thing: security. Is the system secure? That is one. And then also how efficient, swift is the system. Because if I make the payment, I don't want to be told to wait how long. The payment must be efficient system that as soon as the transaction is done, then that transaction can be reflected or can be seen in the shortest period of time. And the most popular payment method or payment method has been through the SWIFT system, which is a messaging system between banks. Okay, and the payment can be done. It could be done using wire transfers, or you can do the payment through what we call cards. You can use your debit card, or you can be able to use your credit card. Okay, or you can even do what we call electronic funds transfer, where funds are quickly transferred from the banks through messaging. Okay, so there are a variety of methods in terms of payment, but the key thing is security, and then also apart from security, we're looking at the swiftness. How fast is the transaction going to be executed? If I am not convinced that the system is reliable, then there's going to be a problem. Like for instance, I think you've witnessed there's been trouble with MTN system, okay, of payment. So if I'm using mobile money and the mobile money system delays, it takes time. I was trying to do a transaction on Saturday. I tried the transaction on Sunday and it was giving me a little bit of trouble. That creates a problem with importers and exporters. It creates uncertainties. The money safe. What is happening to this system? Okay, some people talked about losing money because of the challenges over the weekend with MTN. I don't know how true that was. You can now imagine if you are sending millions or billions and you're making payment and you're not sure about security, what it means, and then you're also not sure how fast the transaction will be concluded. Okay, so when we talk about risk, we are talking about the ability to remove the broad range of risks which are across the globe if you are involved, especially in trade. So this could be individuals or firms who are involved in international trade or global commerce. And by their nature, they have to tolerate risk, but they have also to reduce this risk. So trade finance instruments must be available, which are designed to assist the importers and exporters to reduce or lower or to overcome the risks that may arise. You know, there are various risks which you could face. There could be civil unrest, there could be a revolution, there could be a financial crisis, there could be country risks, there could be risks related to insolvency or non-performance. But the question is, do I have the instrument? Do I have the product that can be able to guide? So I'm selling goods to somebody in Uganda, but I don't know this person. There could be a risk of non-payment. So can I be able to take out this cover so that I add this risk just in case it occurs? Okay, so that's why you have insurance. But there's a whole broad of instruments, not only insurance, also other instruments which are designed to be able to provide you with the cover from the risk. Okay? I'll jump that. This is still about risk mitigation. Now, when it comes to financing, aspect that as a person who's involved in international business, what you're looking for is a variety, is to look for a variety of funding options. There should be a variety, not limited. I want to pay X in China, but what do I have to be able to make this payment? What is available? I don't have $500,000. So what is a broad range of instruments from which I can be able to pick from so that I can be able to finance the transaction? That's what you're talking about here. Now, what this necessitates is that the providers of the trade finance do have customized or can do also off-shelf products for you so that finance your business. Maybe it's a supply chain finance, maybe it's a letter of credit, maybe it's something to do with you managing your working capital. Maybe it's something for you to manage your forex. Okay, so you see that as you're involved in trade, you have to pay taxes. You have to worry about foreign exchange fluctuations. You have to worry about transportation, that is freight. So do you have a variety of products to be able to cater for this? So if you look at the value chain that you have, can I be able to have value chain financing? Excuse me? And that's what you're looking at, okay? So we shall be doing an exercise where we shall be looking at banks and trying to understand what products do these banks have so that you become proficient in providing advice and support to somebody who's involved in trade finance. Even when you go to the bank, you're able to understand, and maybe you're put in the trade finance division, you're able to fit in properly because you have a proper understanding about the products and services in the bank so that you can be a good trade finance consultant or advisor. Okay, now information. Information is a strong pillar. If you don't have information, you cannot make timely decisions. So access to timely information is important. This information is for everybody who's involved in trade, importer and exporter. Even the funder needs information. If you don't have information, you cannot be efficient and you cannot be competitive. Take for instance, I'm importing goods from Shenzhen. I need to have information when the goods are being put on the ship. I need to have information when the goods will arrive at Mombasa or Dar es Salaam. I need to have information about taxes. I need to have information about customs clearance. Likewise, the banker also needs information about you, basically, about your business, because the decision to give you a product is bent on the kind of information that you provide. Likewise, also the exporter needs information about the importer. Okay, so you see, information is key in moving international business. If there's no information, then we cannot be able to make key decisions. But the information must be timely, okay? Because we're dealing with transactions which are highly risky sometimes, okay? And the only way we can be able to understand and make proper decisions is by relying on the information that is provided. So information is a key pillar. And if this information is not managed very well, it may be lead to disastrous consequences. Now, what are the risks? Now, doing international business is more riskier than doing business in your country. I hope you appreciate this. Doing business within Uganda is not as tricky as doing business outside. And the reasons are the various things that we'll face when we leave our boundaries or our borders. We're dealing with different laws, regulations. We're dealing with the foreign currency, its conversion. We're dealing with the logistics of exporting and importing. All this must be factored in. Now, these risks in international trade will not be borne by the importer and exporter. Rather, these risks will be kind of pushed on to a third party, that is a bank. Okay. So what are these risks? Some of the risks are here. And these are not all the risks. Okay, the various other risks as well. But the risks which are to do with the counterparty, the risks that we do with the country, forex is something that we talked about, dilution, insolvency, fraud, and compliance. So we need to be able to understand this. So if I'm working in a bank or I'm a trade finance advisor, I'll be asking the importer or the exporter about these risks. What is your assessment around counterparty risk? Let's look at the country risk. You're importing goods from China, from maybe Lithuania. Okay. And why am I focusing on why do we look at Lithuania? Because Lithuania is next to Ukraine, and everybody is saying, oh, you know, the Russians may also attack Lithuania. So there's a country risk. Then there's likely to be an insolvency risk. Okay. Oh, maybe I'm doing business with somebody in Russia. Becomes a problem. There's a compliance risk because Russia is now under sanctions. So you cannot do business with the Russians. So if you do business with Russians, there's an issue of compliance. Okay. So I'll explain this, and where you don't understand, you ask. So far, any questions? Everybody's okay?
Yes.
Explain for me counterpart risk.
But that's where we're going. let's be also courteous when we are asking for something. You don't explain to me, yeah? At least you add the please, sir. You know, it's like you're commanding me, yeah? Let's be careful about our language, yeah? But it's okay, I'm going to explain that. Okay. When you talk about counterparty, we are talking about people who are involved in the transaction. So there are parties involved in the transaction. That is important, exporter. So if the exporter fulfills his side of the obligation in a transaction by exporting the goods or selling the goods, the importer is obliged to ensure that he makes the payment. Now, if one of the parties does not fulfill their side of the bargain, that is what they're supposed to do, then there is a counterparty risk. Is that clear?
Not
okay?
really.
But this is simple English. And listen to what I'm saying. When you're talking about a transaction, we're talking about parties involved in a transaction. So whoever is involved in that transaction has to fulfill part of what is expected from them. So if one party fails to fulfill, then there's a counterparty challenge. That is what we're talking about, the counterparty risk. So if you read that first sentence, you're saying counterparty risk refers to a risk of default if one or more of the parties in a transaction does not fulfill the bargain. The default could be in relation to a payment of monies or performance of a contractual obligation, which may result to a possible loss for one of the parties. Maybe it's a financial service provider. Is that clear? Yes?
Yes, it's clear.
Good. So just know that whenever you're involved in the transaction, that could arise a counterparty risk. And basically, we're talking about default on one of the parties by failing to fulfill their part of the transaction. So every counterparty in a trade finance transaction represents a certain level of risk. And the finance provider needs to assess the risk to decide if you will accept that risk and on what terms. We're together? Okay, so let's assume that you have somebody comes to you and saying, I want $500,000, I'm in a bank. So you need to be able to understand who is the exporter and who is the importer. What is the reputation of both of them? Then you start to analyze the risk. Who of these two is likely to be risky? Now, when you're doing that, you're looking at the counterparty risks. What are the likely counterparty risks that may arise? We're together? Yes?
Yes, sir.
Okay, I'm going to jump it's self-explanatory. Then when we talk about political risk or country risk, is risk that may arise from actions of government or even regulators, which may be detrimental to trade or with counterparties within their jurisdiction. Now, the causes could be varied: political tensions, economic crisis, or political instability. Now, this is the example I gave you, that doing business with somebody in Russia now is very, very, very risky. Why? Because of the political tensions. Okay? There is an ongoing war. The sanctions. Now, you don't want to be in violation of the sanctions. All right? And if you're in violation of the sanctions, then what they're going to do is they're going to look for you who is violating the sanctions, and then you're also going to be penalized. Your accounts will be frozen. Okay? So, for instance, a few years ago, I was doing something in Sudan before they removed the sanction on Sudan, and then somebody in Nairobi was supposed to pay me, and when that person, what the person did was to write a check to pay me, and the check went through the central bank. I went through the bank, and then they asked the question, "Why are you paying him?" Because we are paying him for work done in Sudan. So what happened is this raised an issue. Oh, this guy is violating sanctions. He's working in Sudan and is getting paid. So the Central Bank of Kenya was now looking for me. That payment was frozen. You see, it caused problems. Right? Because everywhere you go and everyone say, you are highlighted, you are violating sanctions. And that was not the case. So people have to be very careful and understand what are the geopolitical dynamics, what is the economic situation like, and what is the political situation like. So if you don't understand those risks, then trade is going to be compromised. Okay. So still there are slides on this. I won't go deep much into it. There are also risks that could arise. A risk which is related to foreign exchange. And basically here we are talking about exchange rates being fluctuating up and down. And maybe a conversion. You have maybe Sudanese pound, or maybe you have Zimbabwe dollar, and you cannot easily exchange Zimbabwe dollar into another currency. Okay, now this will impact, because as a businessman, if you pay me and I hold this currency, I want to into another currency so that I can be able to do business. Can you please mute? There's somebody who has an open mic and the phone is going on and off, please. So what is important is that we need to be able to understand how does the foreign exchange market work, and how is it likely to impact me as an exporter or an exporter. Okay, so am I able to convert the currency? I have Ugandan shillings. Can I travel with Ugandan shillings to Dubai? That may be a problem for you. But if I carry the US dollar, I will easily sell off the US dollar in any place. Okay? Or maybe I get the Congolese Congolese currency. Or I get maybe the Russian ruble. Nobody may be willing to take the Russian rubles now. You cannot easily convert them. Okay, so that means you must be careful in terms of what currency are you using to invoice your transaction. Are we still together?
Yes.
Dilution,
Yes.
dilution itself refers to risk which may arise because the amount that has to be paid by the data on the trade receivable is less than what you invoiced. So let's assume that, for instance, I entered into a transaction with someone, and the person was supposed to pay me $100,000, and now the person is paying me maybe $60,000. The invoiced amount is $100,000. That has to be paid, but what I'm getting now is $40,000. Now, what could cause this dilution? Why could cause this lack of payment of the $40,000? The reason could be maybe the goods were damaged. So the person not paying the full amount, the goods are damaged. Or maybe there is an issue to do on the warranty. You claim that this good is working, but when I used it, it wasn't working, so I returned some of the goods. Or maybe there's a commercial dispute. So somebody says, no, I'm not satisfied with these goods. So I'm not going to pay you the full amount. I'm going to pay you just half of the amount. So this is what we mean by dilution risk. Okay, and I've given you the reasons. So that is also likely to impact the trade finance. So these are some of the risks that could arise. So dilution risk may reflect performance risk, just performance. Performance means that one party does not fulfill their part of the bargain. Okay, and so there will be a return of the goods and all the rest. Now, some of the mitigation measures for dilution could be, did you do due diligence? Did you check the goods prior to financing or prior to payment? Also, you can use unconditional payment instruments like bills of exchange, promissory notes, so that you create a payment obligation separate from the commercial transaction. Also, there could be, did you put in what you call terms regarding recourse? If for instance, I'm not with the look of the goods or the performance of the goods, what do we do in that case? So as you're contracting, you also must look at recourse. And I think recourse means fallback position. What is the fallback position? Okay. Last, the risk of insolvency. Insolvency basically means that it's likely that one party may go bankrupt, may go broke, and they're unable to pay the debts or fulfill their financial obligations. They may have cash flow issues. They cannot sell their inventory. Okay, so it's important, and maybe they've been put under receivership or bankruptcy or under trustee or liquidator. Okay, so one of the tricky issues is also to look at the level of solvency. Now, you remember from your financial management, you looked at solvency ratios. Now, this is where the solvency ratios come in. So you should be able to know, okay, how do I check for solvency? So I try to do a bit of solvency ratios to determine the ability of somebody to be able to fulfill their bargain. Okay, so the finance provider, you see, as a finance provider, you don't want to get caught up in a solvency trap, because you'll find other creditors are also coming for the same piece. Maybe person said, if in case I fail to pay, you will take the building. But he has given out this bill, he has kind of provided this as security to so many creditors. Now, all of you are coming in to scramble for the same building. So how much will you get? So you need to know which encumbrances are in there. Now, the last one is basically, not really last, okay? There's also fraud. Fraud risk basically can also be a challenge. And fraud risk refers to deception, intentional deception. In many cases, people deceive. And the fraud is basically perpetrated against one or more
Recording in
any
progress.
terrorism, whatever, you've not been charged, that kind of thing. Okay, so basically fraud relates to documentation and the kind of information you're providing. Okay, so some people may intentionally deceive. Okay, so so fraud is a big issue in international trade, and because international trade basically is reliant on proper documentation. So there's no assured protection against fraud. The only way to overcome fraud is by doing due diligence or applying what we call a 4I principle. 4I is meaning that you have two people, you know, one person looks and then another person also looks and says, yeah, this is okay. Okay, so there must be a 4I principle. There must be proper due diligence on customers. There must be independent verification of facts. Maybe you hire someone and tell him, you know, we want you to go and be able to double check this information. Okay, for instance, check the vessels on a ship, MV Vanessa. So we need you to go and check this Vanessa. Is it a seaworthy vessel? Is it insured? Or maybe somebody put a price. We need somebody to go and check that price. So there must be a verification. Okay, now I think this will be the last one. There is basically compliance. Now, compliance refers to being in line, being in check with the requirements in terms of regulation. Okay. Now, if you're financing, if you're a transaction, you want to ensure that there's full compliance. And on the side of a banker or a financial, you're checking in terms of anti-money laundering, which we call AML, or you're doing CFT, which is countering financing terrorism. Okay, so these are important. For instance, do you know your customer? That is the first key thing in compliance. $100,000. But this $100,000, what are you going to use it for? Now you start beginning doing the know your KYC. Who is this client? Where is this client? What is he using this money for? How long has he been in the business? You're building up information to try and understand. Now, if you do not meet compliance, you're going to get sanctions, or you're going to get penalties, or you're even going to get your license withdrawn by the regulator. That is the trouble. So a financial service provider will face risk of being unable to collect on a repayment or reimbursement if they don't do compliance. Okay, so are we together?
Yes.
Okay, so we need to recap just a little bit. We go back. We're going to go back a little bit, just a little bit. Going a little bit fast. We say that these are the risks, but there are various other risks, but I've just broken down this and say the risks can be counterparty, country, foreign exchange risk, dilution risks, insolvency, fraud, or compliance. Somebody needs to mute. Can you ask somebody who has an open mic? Do we take a small break?
Mukisa, can you please mute your mic?
Do you require a small break for 5 minutes?
Yes.
Okay, 5 minutes. We return at 11:51.
Yes.
Okay.
What is the meaning of this now? We have just begun and we are
break for what? You go marathon and you finish this stuff.
Why don't you want a break? You rest, you tired.
Yeah, we don't want break because data is growing, you know.
You think logging in is easy as for you, it is easy on your side. Please, it's not. And when someone starts, it does not
dear.
even want to log off.
Okay, I think we can get back. We can shut our mics for those who are open. Okay, now what we want to do is address something very important, and that is the payment. Remember, we looked at the pillars, and one of the pillars was something to do with payment. Now, payment is critical because if there's no payment platform, if there are no payment methods, if I'm not sure about payment, then I wouldn't want to get involved in business with anybody. Now, payment affects both the exporter and the importer. The exporter is sending goods, so it's expecting payment. The importer is making a payment. The importer must feel secure that if I make this payment, the other party will fulfill their obligation. They will send the goods, that is. So now the challenge is that how do we handle that conflicting need? How do we balance the two? So during or before contract negotiation, it is important that there's an agreement on what will be the most suitable payment method. If somebody has an open mic, please let's shut it down. Okay, thank you. So this is what we are going to look at now. We're going to now analyze this in a payment risk diagram. Now, this payment risk diagram highlights 5 ways in which we can be able to manage risk. And it is on a continuum of being what will be the most secure method to what will be the least secure method. Now, the analysis is done at a 2 level where you're looking at the exporter and the importer. Now, if you look at the top here, you're seeing that when I go this way on the left, and it says least secure here. When I move towards the right, it is most secure. So at the top, you have the exporter. Then at the lower level, you have the importer. Now, what is most secure is cash in advance for the exporter. Next is letters of credit. Once you move towards the left, the documentary collections, the open account, and consignment are least secure. Now, if you look at the bottom, we have the importer. What is most secure is the consignment, open account, and documentary collections. What is least secure is basically the letters of credit and the cash in advance. We're together?
Yes.
Can we internalize this? We're together?
Yes, sir.
Okay. Please let's get this straight before we go into the notes and the content. Otherwise, we'll get lost. We need to be able to understand. What you're trying to address is what is the most appropriate method. And these two parties, importer and exporter, have to agree. What provides them security? What provides them comfort? You see, cash in advance does not provide comfort to the importer because the importer is losing working capital. Yet the exporter is getting money, so he doesn't have the problem of collecting. I don't have to wait for another day, a week, a month, a year. That's what we are saying. But cash in advance is not secure, not secure, you see. So you can see here, cash in advance is most secure for the exporter, but it is least secure for the importer because the importer is losing working capital. Yet this one is not going to have issues of accounts receivable, no debts. Are we together now? Yes? So these are the principal methods. So we are going to start explaining one by one. Cash in advance, basically, as I've explained, made available to the exporter. How is it made available? It can be cash down. It can be through wire transfers like EFT. cards or debit cards. Okay, so what the good thing is that side of the exporter, money is advanced even before the goods are made available to the buyer. That is the importer. Now, the importer is the only one who is if the buyer fails or the exporter fails to fulfill their bargain, then what is the recourse mechanism that they have in place? Okay. Now, the next method is which we are going to is what we call letters of credit. Now, letters of credit.
Excuse me, sir.
Yes.
Sir, could you please slow down? You seem to be a little faster for me. The other thing is the diagram, the risk, the payment risk diagram. Could you just peruse through it a little more? Thank you.
But I asked and nobody asked. Said everybody said they're fine. Is it just you?
Yes, sir.
I'm going to flash it, but I'm not going to go back.
Even me.
The notes are clear. When you read, you'll be able. You must have the notes. I shared them with the course leader. Did you share them?
No. No.
Yes.
I didn't ask him to share with you. It's just a bit. You need to do some bit of reading. You may not comprehend it now, but when you do some bit of reading, you'll understand. All right?
Okay, sir. But sir, could you just explain it some more, please?
No. Time. Let's first do the reading, and then you can be able to let me know if you didn't understand it. Let's first do some bit of reading. So I want to explain a little of credit, which sometimes we call the documentary credit. Okay, so understand that sometimes we use interchangeable words, letter of credit or documentary credit. We're talking about one thing. Now, a letter of credit or documentary credit is a secure payment method. And the method, it works in such a way that one party is instructing his bank or asking his bank to make a payment on their behalf. So you have an importer or the buyer asking his bank, make a payment to X if X fulfills the following conditions. Okay? And those conditions are basically providing proper documentation. Now, the importer or the buyer is the one who tells the bank the documents that you need. Why does he tell the bank those documents? Because those documents, he needs them to present them to customs when the goods are available. And I'm going to show the trail so you can be able to understand it. But a letter of credit basically is a commitment by the bank to make a payment on behalf of their client, who is the buyer, provided the exporter fulfills those conditions, as you can read from here. So what the buyer does is he establishes a credit, and he's going to pay his bank for a service which is rendered. Now, the useful when you don't have reliable credit information about the foreign buyer. So if I'm importing goods from China, and a person in China says, but I don't have good information about you, so how do I pay you? And then you say, oh, is the letter of credit okay? Yeah, the letter of credit will be acceptable because the bank is saying we shall pay. You see, the satisfaction that the exporter has or the seller has is that the bank is going to pay. Now, nobody will say, I am not selling goods because I'm not selling goods because they will trust the bank. So an LC provides protection to the buyer since no payment obligation arises until the goods have been shipped as promised. Okay, now we are going to go in there. Let's try and understand this. Now, there's a correction which has to be made. This is not collection, it is credit. Let's be clear. This is not collection, it is credit. The documentary collection is different. So the first step, you can see here the buyer or the importer enters into a contract with the seller or the exporter. And then they agree that they'll use a letter of credit. Why they agree a letter of credit? Because the seller is convinced if payment is coming through the bank, I don't have a problem. If the bank says it will pay, I have no problem. You send the goods. Now, if that is the case, then the buyer will contact his bankers. That is the importer's bank. In this case, it is what we call the issuing bank, and tell them, make a payment for me of $500,000 to the seller. Okay? Once this bank receives this instruction, remember the bank is in Uganda, but the bank does not have a branch maybe in China. So this bank looks for a counterpart party that they do business with in China. Let's say it is Hong Kong Bank. Now, Hong Kong Bank now becomes an advising bank. And the instructions are, we are requesting you to make a payment on our behalf. The instructions are coming from this bank. We're requesting you to make a payment on our behalf to this person. And you are supposed to pay him $100,000, provided he delivers.
Zoom user, can you please behave?
Guys, mute.
Zoom user, I am going to follow you up and establish who you are, because you normally interrupt our lectures. So is let's continue, sir.
The lecturer has left because of that Zoom user.
The lecturer. Who is that really? I'm sorry to use the word myotic. That boy should style up, and he's a boy. That boy, ever since second year, he disturbs people a lot. He plays music for people. He thinks it's just a matter of wasting people's data, and some lecturers don't joke. They just go. Let's behave, please.
Are you going to follow up the guy?
Okay, I temporarily went off. Let's try and get back. Let's try and be sensitive about what we are posting in the chat. Are we together? Course leader, can you advise your colleagues to be careful about what they post in the chat?
Yes, sir. We are sorry for that.
Okay, so when I stopped here and saying that the exporter, at this stage, you need to be able to understand this, what we call advising bank, because it's advising this exporter. For you to get paid, these are the following documents that you need. Please present them to us. All right? Now, that the seller does here is to ensure that he gets the proper documentation. Now, for instance, one of the most important documents is what we call the bill of lading. Or sometimes you can call it, or if you leave the goods on the ship, you need the bill of lading. Or you're going to put the goods on a plane, then you're going to get an air freight bill. Or if you're going to put them on the train, then it's going to be a rail freight bill. Okay. Goods are put on the ship. So a bill of lading is issued by the ship. Now, these documents basically are stipulated by the buyer. Okay.
Mute.
But the invoice, the bill of lading, insurance documents. It could also include letter of indemnity, certificate of warranty. There are also a couple of other documents, consular note, certificate of origin, the many documents, depending on the country, it varies. But what happens is that these documents are presented to the exporter, and the exporter, the advising bank, and the advising bank is simply checking the documentation. For instance, remember you entered into a sales contract. Now that sales contract will have the names of the buyer and the seller and the amount and the nature of the goods. Now the bill of lading will also have where are the goods going, who's the buyer, where is the port of offloading, and the type of goods and the status. Okay, the state of the goods, are they damaged? Are they in more good order? You get it? Now, what happens is the banker is looking. What was the names in the contract? What are the names on the bill of lading? Or you also provided an invoice. Does the names on the bill of lading and the contract match with the bill on the bill of lading? Does the contract price match with what was invoiced? So this is what the bank is trying to check here. And the moment they are satisfied, okay, they then inform the issuing bank that we are either satisfied or we are not satisfied. Now, let's take, for instance, they are satisfied. Say, fine, proceed with the payment. Now, if this bank is going to proceed to pay this person here on behalf of this bank, then it's done from being an advising bank, what we call a confirming bank. So this bank can do two things, being an advising bank and a confirming bank. For it to be a confirming bank, it is saying we are going, that is the seller or the exporter. So this is basically what the rate of transaction is. It starts from here, you enter into a contract, you request for the credit, then you ask another bank to make a payment. This bank contacts the other person. This person provides the documentation, as you can see. But first, before they present the documentation, the goods must leave, okay, the warehouse. That's when the bill of lading is issued, because it reflects passage of title. And then you present the documents. Once these guys verify the documents, they send them to this person, to the bank. The bank agrees, make the payment, and then they send the documents to the buyer and tell the buyer, we have cleared the payment on your behalf, come and pay us and come and claim for your documentation. So then the buyer can go to customs and clear the goods and then is able to sell. But in simple, what has the bank done? The bank has provided a guarantee to pay, which this seller would have been worried about. I sent goods, but I'm not sure when I'll get paid. But you have the willingness of the bank to be able to cover that transaction. That's what we mean by a letter of credit. Okay, we can proceed. Is that fine?
Yes. Yes.
Okay, I'm not coming back. Don't tell me to come back. Are we fine? I'm going to
No, it's
move
okay, sir. Let's proceed.
Okay, fine. Now, there are various types of letters of credit. Very many types. So these are the types of letters of credit. Now, I'm going to go through some of them, but I'm not going to define. I'm going to simply provide examples so you can be able to understand. Okay, let's start with the transferable letter of credit. In most cases, the exporter is contacted to provide goods, and he says, yeah, I'll be paid by a letter of credit. But it so happens that the exporter may not actually have all the goods. So the exporter requests another person to supply the goods. You know, let's take, for instance, I'm importing goods from China. But the guy in China, in Shenzhen, finds he has 80% of the goods. So he has to ask another guy in Vietnam to supply the other remaining bit. So in this case, the other person in Vietnam says, okay, what is going to be the payment method? And then this guy says, well, I'm going to be paid by a letter of credit. But then this party, you see what happens is that in the initial contracting, two parties were involved, the exporter and the importer. A third party has come into play. Now, this third party may say, okay, I also want to be part to that contract, to the transaction. Now, the first exporter cannot say, yes, you can. No, he has to ask the buyer, because the buyer is the one who is authorizing his bank who has to be paid. Now, if a third party is going to come into the letter of credit, all right, then that means that there is going to be a transfer of part of the payment, or what we call part of the credit, to the other party. Remember, one is providing 80%, another is providing 20%. So if the buyer is okay with that, then they will issue what we call a transferable letter of credit, which is basically an instruction. Pay exporter in China, also pay exporter in Vietnam. Because what should have gone to the guy in China, said, no, 20% should go to the person in Vietnam. So part of the letter of credit has been transferred. That is where the name comes from. That's what we mean by transferable letter of credit. Is that clear? Yes? Are we clear? Are we together?
Yeah, man.
Okay, fine. Now, we also have what we call a standby. Now, we still use the guy in China, and let's assume that the guy in China has agreed to a letter of credit as a payment method. But he's not comfortable with the confirming bank. He's not comfortable with the confirming bank. So what he asks is, I would like another bank to guarantee that in case the confirming bank, remember the confirming bank is in China, fails to pay. In case the confirming bank fails to pay, another bank comes in and pays. Now, that bank which comes in and is on standby to pay in case the confirming bank fails to pay will now be issuing what we call a standby letter of credit. So let's take, for instance, Hong Kong Bank fails to pay. Then what we are going to do is we are going to say, okay, we can ask HSBC in Hong Kong, HSBC Bank in Hong Kong, to be on standby. That in case Hong Kong Bank fails to pay, then HSBC can be raised on the phone or by email or contacted so that the exporter is paid. So standby letter of credit is basically a letter of credit which is on hold in case one of the confirming banks in the initial transaction is not able to pay. Is that clear?
Yes.
Yes.
Okay, now we also go to revolving. Now let's take also, for instance, that same party is importing from the same person throughout the year. But after every 3 months, you're making order for the same goods, same amount from that person. So what you're doing is that after every 3 months have passed, you contact that person in China and tell him, send me the goods. Now, instead of going to the bank and asking the bank to prepare a letter of credit all the time, let's say, for instance, in January, you requested. Then after 3 months, that is in April, you are requesting. Then after another 3 months, maybe in August, you are requesting. Now, instead of going to the bank and incurring charges to open up a letter of credit, you simply tell the bank, open this letter of credit for 1 year. But ensure that you avail me a credit of 100,000 each time after every 3 months. Because now, when you do that, what you have done, that letter of credit is what we call a revolving, because after every 3 months, it revolves. I don't know, have I explained that well? Have you understood it?
No, first pardon a little bit.
No, sir.
We are saying that instead of importing goods after every 3 months, instead of going to the bank each time to ask for a letter of credit to be opened, you open that letter of credit once in a year. But the instruction to the bank is keep the same volume, $100,000 available. All right. Now, if you have that letter of credit which is open and it's the same volume of money, then that is what we call a revolving letter of credit. Because after every 3 months, you're using it. So you don't have to go to the bank and tell the bank, open another letter of credit of 100,000, open another letter of credit 100,000. The amount is revolving. Is that clear now?
Yes.
Yes? We are together?
Yes, sir.
Yes, sir.
Yes, sir.
Okay, fine. I think let's stop here.
Thank you so much for watching. Make sure you subscribe to the channel.